So welcome everybody. It's great to have you with us this afternoon. We've got a fantastic lineup of people here today to discuss what should be the Institute's public policy statement around retirement incomes. And you might be forgiven for thinking that this would be a straightforward topic to discuss, but unfortunately it isn't. And although the Institute now has a formal public policy position on climate policy,
we may have just lost her.
Oh, great.
All right. Would you like me to run a little bit more of the introduction then while we get Naomi back online? So luckily we did have a backup just in this eventuality. So my name is Nathan Benares, Director at PwC. So yeah, I think today really I won't take too much time doing the introduction. I'm sure Naomi had much better words written, but I think really we're here today to talk about the Actuaries Institute public policy position for retirement incomes. The Institute has had a position for many years. We've also contributed to retirement incomes policy across a number of levels. More recently, we've done a pre-budget submission. We've contributed to the retirement incomes review. We've done work for all the other major reviews into superannuation recently, and we do have a current public policy position where we've clarified our thoughts on issues such as the objective of the retirement income system. But what we wanted to take the time to do and put back to the membership was really in light of the retirement incomes review, which was released to the public last year, is actually to take into account the kind of new wealth or 600 pages of that additional research, which we've got to digest. And some of that information may be a little bit counter to some of our original thinking or some of our original positions, certainly in relation to, for example, the superannuation guarantee, where the retirement income review has really said that 9.5% is enough. So what we wanted to explore today is have a little bit of an update from three really good thinkers in this space who have been crafting the Institute's policy in these areas for a number of years and contributing to it, but also to put that back to the members and get your views on what you think the Institute's position should be on a number of those issues. So I think perhaps first, just to introduce the speakers, and I don't have your bios in front of me actually, but do you want to do a quick introduction each of yourself, Andrew, if you go first? Here's Naomi.
Naomi has the introduction, so she might be able to do those now she's back.
hey everyone, apologies about that, the joys of Zoom. Nathan, have you introduced the session?
I've introduced the topic and I was just getting into the bios if you want to do that. And I haven't gone through any survey results.
Great.
So I'll hand back over to you at that point there. Thank you.
Apologies, everyone. I've just switched to my iPad. So we've got a fantastic lineup of speakers here today to speak with you. And starting off, we've got Andrew Boal, who's the CEO of Rice Warner and a member of the Institute Public Policy Committee and chair of the Superannuation Group and ex-convener of the SPC. And my screen has gone blank. Am I still? Yep, still there, great. And during his career, Andrew has driven an amazing amount of research and public policy into the superannuation area. We're also joined by Tim Jenkins. Tim, as many of you will know, is a partner at Mercer He's an advisor and the RSE actuary to many industry super funds and trustee groups, and also an advisor to many super funds, and currently the convener of the Superannuation Practice Committee. And last but not least, and known to many of you, we're going to be joined by Anthony Asher. And Anthony has very recently, Anthony's a fellow member on the council with me at the moment, and has recently retired from the New South Wales UNSW, where he was a professor in the business school and also a greatly respected professor in the area of ethics and business as well. So it's fantastic to have you with us. And I'd like to particularly thank Nathan, who's on the line with us as well, for stepping in. So basically the agenda for today is that we're going to kick off with a very brief discussion of the results of the survey that we ran last week. And thank you so much to all of you for participating in that survey. It actually gives us a really great base on which to move forward. We're then going to have the three panelists talk to the questions in the survey and kind of use that as a springboard to discuss where we might or might not develop an institute public position. Then we're going to have a Q&A, and that will probably run from about 1:15 to 1:45. And then we had an idea that at 1:45 we would actually re-poll everybody on this call. So stick around till 1:45, because what we want to see is whether, as a result of our discussion and hearing from our industry experts today, people have actually changed their minds about the various potential positions. And after that, I know that the team at the Actuaries Institute will go away and work with the Public Policy Committee and the SPC and the Retirements Group to actually work out what proposals we can put forward to government. We do have a really big voice in this area, and Treasury is always very interested to hear from the Actuaries Institute. So maybe without further ado, I might ask Zoe if you could pick up the first question, which was about the level of SGC that should exist in Australia. And Andrew, I might just pass over to you to talk to these results and your thoughts on it.
Yeah, thanks, Naomi, and good afternoon, everyone. Interesting results, and in a way, not surprising. I think the good thing from the Institute's perspective is looking at the second and third answers in particular, that there's about a third of responses supported the increase going to 12%, and slightly more than that, saying it should be somewhere between 9.5% and 12%. And I think those answers are quite reflective of my thoughts about this. One of the things with the superannuation guarantee, there's a number of things. It's really complicated, and that's why there's a range of views that are all quite reasonable about what the level of the SG should be. The level of the SG, first of all, the superannuation guarantee is compulsory. So the first part, and I wrote a paper about this back in 2006, is that what's the right level for a compulsory superannuation amount? And I think that's part of the discussion that the government's thinking about at the moment now as well, is that the SG level is not meant to be the rate that's providing an adequate level of income for people in retirement. It's the level of the compulsory part of that, and that people are able to make voluntary contributions in addition to that to make their own situation adequate or not. And so there are some quarters that over many years, there's been research done that without compulsion, and a lot of this was done by some behavioural scientists in the US, that compulsion is the best way to get things done, because of behavioural science, people will discount the future way too much and end up, if they have an opportunity to spend money today versus saving it for 30 years' time, they'll always choose spending it today. So therefore, in the US, there's particular work done around soft defaults, where people were default or was given, and then people were given the opportunity to opt out of it as a way to encourage people to save more in a non-compulsory situation. But one of the great things about our system has been that compulsion has meant that we've got a great level of savings in the industry, and it's already having great inroads into offsetting the age pension. But back to the other complications. So first of all, it's what's the right level of compulsory contributions, and should that be enough to make it, retirement savings adequate for most people, or should there be an element of voluntary savings involved there as well? But it's complicated by the interaction that it has with various features, such as, in particular, the most common one is the age pension, and the age pension will depend on how much money you have in other assets. It's different depending on whether you're single or married. And 70% of people go into retirement with a partner, but 30% don't. And also is affected by whether you own your own home or not. And so home ownership is a big issue. That it's quite common that couples who own their own home will have a better standard of living in retirement than singles who don't own their own home. And so there's, how do we deal with those issues? And is superannuation the only way of dealing with these issues, or should we be looking at how it's integrated with other parts of the social welfare system, such as rental assistance and other means that we can help support people as they age and in retirement? So all of those things make the system quite complicated. And the most common, the largest one of those is obviously the age pension, and having one fixed rate. So for people who are in the wealthy area that are unlikely to see much of the age pension when they retire, I think they will need to save a higher rate than 12% to have a living in retirement that they might expect. But really, that cohort are able to save voluntarily, get advice about that, and look after themselves. So I'm less concerned about the wealthy 10 or 20% from a public policy perspective. The other group is the less well-off 20 or 30%, and that range can vary. But for this group, the age pension is going to form a substantial part of their income in retirement. And in a lot of cases, their retirement balances when they retire will be around $250,000. And for them, the age pension could well be at least 80% or more of their income in retirement. And so so the age pension will be most of their retirement income. So savings is less important. I think the big group that's a big concern is the group in the middle, where they're going to get a part age pension for most of their retirement. So how do you accommodate the needs of the less well-off and the middle and the wealthy with one rate? And that's impossible, which is why I think the range of 9.5 or 10 to 15% is the range that most people think's acceptable. And the rate will vary depending on the circumstances of the individuals involved. But anyway, I think from a public policy perspective, one of the areas that I've lent to over time was to try and get a rate like 12%, on the proviso that might, because the increases in the SG might be offset against wage increases, that we find another way to at least look after the less well-off and the lowly paid. And so one of the avenues that's been thought about there is using the tax and transfer system in some way to look after the less well-off. And if that is achieved, then increasing the SG to 12% has a lot of merit, because it looks after the people in the middle who do really need 12% to have an adequate level of income in retirement. But I don't want that to occur at the expense of the less well-off. And so if we can find a way to look after those people through the tax and transfer system in some way, then I think that gives it a lot of merit to go towards the top end of the range. I think that's probably enough for me on that topic. Do you want to drop across to the next slide, Zoe? In question 2, we asked a number of questions about other areas of superannuation. I'm going to address a few of these and then pass over to other panelists to go through some of the other ones. But the first one there is around tax concessions for higher superannuation balances. 61% of people thought that there are equity issues and this does need to be addressed. I think if you have a look at the way tax concessions cover the whole of the system, and you look at what's contained in the Retirement Income Review itself, the cost of the age pension also needs to be taken into account, I think, in looking at the level of public support that we're providing to individuals. So if you look at the cost of the tax concessions plus the cost of the age pension for different income cohorts. Pardon me. I think we'll see that it's relatively flat across most income wealth cohorts in 10% cohorts, and there's a chart in the income review that talks to that, except when you get to the very high income balances, and it's when you get to the top 10 or 20% that the tax concessions plus the age pension, well, and for most cases it's just the tax concessions, starts to be much higher in value. So it certainly does show that there is a slight imbalance towards high income earners. And so there are a number of ways that we could address that. But first of all, what's the cause of that imbalance? At the moment, the cost of the age pension is about 2.4% of GDP. And in fact, over the next 40 years or so, it's not going to increase much at all because of the level of savings we have. It's going to stay under 2.5% of GDP for the next 40 years or so. Contributions tax concessions contribute about 1% of GDP at the moment, and that will stay flat over the next 40 years or so. But investment earnings is currently slightly under 1% of GDP, but is expected to grow as balances grow over the next 40 years. We'll expect it to grow to over 1.5%. So really, the one that looks like it's an outlier there is the tax concessions provided to investment earnings. And in particular, investment earnings in retirement are not taxed at all, which gives you a great discount for high income earners, and especially when some high income earners have been able to achieve very, very large retirement balances. So I think there's reported there are 11,000 people or so in SMSFs and that have balances above $5 million in retirement. So one way to try and cap those concessions, especially on investment earnings, would be to limit the large account balances accumulating into the future. We've already gone some way to that by limiting the maximum concessional contributions going into super to $25,000 a year. So that should, over time, eventually have an impact on that. And so it should gradually see that reduce over time. But yeah, should there be a second rate of tax applied to balances above a certain level, or should we just tax retirement balances at 15%? Because it mostly favours the wealthy anyway, so that might be another option. If we have a look at the next couple there as well, the means test, and the means tests have been a passion of mine for a while, especially when the changes to the taper rate were made a few years ago. So should there be no means test on the age pension, together with reduced tax concessions for superannuation? I don't know, there's probably some people on this call talking about having a universal age pension. And if you do that, that's going to be obviously very expensive, much more expensive than the current system. Having the means tests enables us to keep the cost of the age pension to below 2.5% into the foreseeable future. Personally, I'm in favour of the current system with some tweaks, but others obviously have different views on this as well. But I think the means testing on the age pension doesn't enable us as a country to keep control of those costs, and the tax concessions combined with the cost of the age pension out to 2060 will stay below 5% of GDP, which is much better than the situation in many other countries around the world. And that's because, in addition to the tax concessions and the age pension, we contribute ourselves towards our retirement savings. So that goes a long way towards that. And I think the next part there is, should it just be a genuine safety net so that most retirees don't receive the age pension? I think in particular for the group in the middle, you'd need to have a much, much higher SG rate or savings rate to get people to be able to provide for themselves without having any recall at all on an age pension. For me, the part pension approach has actually worked well for us, and it's quite good, except I think the taper rate's probably a bit high, and I'd like to see the taper rate reduced from $3 back to, not back all the way to $1.50 where it was 4 years ago, but somewhere in between maybe $2 or $2.25, which would give better outcomes to Middle Australia. But personally, I think the current means tests and taper rate system help us maintain control over our costs of managing the system, whilst also helping the low income earners and then the middle to achieve better outcomes in retirement. But there is a complication there, and I do support the Institute having a view that it is complicated, and maybe we can find a way to simplify it. And maybe 2 means tests is too much, and we should simplify it by going back to only 1 means test. And maybe the simplest means test would be to have an income test where we had a deeming rate for assets as well that contributed towards their income test. Anyway, I'm just conscious of time, and I probably should hand back to Naomi at this stage.
Right, thank you for that, Andrew. That's really interesting. Andrew, just while we're talking, we had a question in the Q&A with someone just wanting to clarify that the $1.6 million balance cap, the question was, does that mean that balances over 1.6 million are already taxed at 15%? If you just want to clarify what you meant by that.
Yeah, absolutely. So pensions, so if you transfer your money across into a pension, a qualifying pension, then the investment income is tax-free. But if you leave it in an accumulation balance into your retirement period, the investment income will still be taxed at 15%. But I should caution, say not many funds actually pay 15% tax. We have dividend imputation credits and capital gains credits and other things that mean that the average tax rate paid by most funds is about 8%, not 15% on investment earnings. And on top of that, if you put your affairs in the right way, for example, you might transfer money across into a pension account and have conservative assets supporting the investment income and leave in your accumulation balance just Australian shares. And if you just invested totally in Australian shares with dividend imputation credits, you'd still pay no tax on investment income there either.
Thanks, Andrew. We opened a can of worms when we asked the questions because a lot of people said, why didn't you ask about imputation credits being paid on retirement incomes? And why didn't you ask about a limit on the amount of large balances? But I get the feeling if we look more broadly at the answers, we can see there probably would be support from membership around some kind of limit on those balances or some kind of, tax on investment earnings and retirement incomes. So thank you. So our next speaker is going to be Tim. And Tim, you get to offer observations and thoughts, I guess, on the next 3 questions in the slide, which relate quite widely to the age pension, but also the means test and whether we should include the home in that means test. So Zoe, maybe if you can put the slides up, and Tim, if you could talk to those next 3 questions.
Hi, thank you, and hi everybody. I'm going to focus on retirement income itself. So Andrew's talked you through SG means tests. I'm going to come in and start to address some of the next questions we have there, which go to the integration of our complex system. Andrew mentioned it's pretty hard, our Australian retirement income system, to understand it. Doesn't mean it's not a good system, but the way the interaction of age pension, superannuation, whether it's compulsory or voluntary, housing and all the preferential treatment housing gets, both before and after retirement, and other financial assets. How do you integrate all those in a way that works for people? Now, the retirement income report, one of its main conclusions coming out of that was that people don't spend enough in their retirement. People are risk averse. And in that environment, they actually say consuming more of your retirement assets is perhaps the most effective thing of all to raise living standards in retirement. Not necessarily the SG level itself in isolation, but how you spend. Now, the report itself didn't actually go into the detail of how to do this. It raised observations. It didn't go into the nitty gritty. We might pick on 1 or 2 of those points, but I will just raise in the report one thing it did put forward, and we haven't surveyed people on this, is that it actually said you need an objective for the overall retirement income system. Not just superannuation, but the system as a whole. And it framed that in terms of adequate standards of living in an equitable, sustainable and cohesive way. Now, we haven't polled people on that. I think that's like an institute view on that from what we put in the Treasury pre-budget submission. But I think that is important as we go into the questions here and how people respond. So how do you get people to spend more? in their retirement if people are risk averse? Look, part of the issue there is people don't know how long they're going to live, and the way we have our current structure with a lack of retirement income products, it's all far too easy perhaps to oversave. Well, I'm going to live to 95 rather than 87. I'm not average. I'm going to live longer. So you've got that. Then you've got the risk aversion to spending capital. That's not really helped by the rules we have on the minimum drawdown rates. If you actually just spend your minimum drawdown rate every year, you're going to end up probably with a bequest. So perhaps that's an area that needs to be focused on. Maybe that should be raised a little on there. And really the whole point we have here is that if you're averse to spending capital, where does that leave you in a low interest rate environment? You have to change that mindset. So perhaps it's not surprising that people pass away with bequest, but it is good to see the question we put on here, which is that we should really have a policy supporting spending it in retirement, not passing it on, which is quite a high percentage vote we have from the membership as a whole. The retirement income report didn't go into the conclusions of the FSI report and SIPPers. That was silent. So that is one of the things that we've put forward, and you can see from the membership as a whole that there's strong support for super trustees offering appropriate retirement income products to their members. Now, one of the hard things there is if you're ever working in product management, there's no good just building a product if no one comes to it. Legacy products is one of the hardest things you can have. So whilst we can be very supportive of that, one of the questions we have sort of open here is, should you actually require every fund to offer one, or should there be a mechanism to help people in a different way, perhaps? They should be available. There should be a bigger marketplace for this. There's certainly definitely a role for actuaries in this sort of area, which is quite important, I think, for institute policy, encouraging use of actuaries in the retirement income world on that. So, should you have them? Should they be compulsory? The next stage from that we didn't actually ask on this is that should you actually be required as an individual to take a retirement income product? We didn't actually ask that question on this. The mood of the government at present seems to be one of flexibility over compulsion. So it would be quite brave of us as an institute to come out with that view. To Andrew's points earlier, people are in very different situations because of the complex system that we have. Integration of age pension, superannuation, other savings. Forcing things might not be the way forward. However, we have strongly put forward that we want a focus on continuous innovation in retirement income stream products. The Institute's got its Retirement Income Working Group, which Anthony chairs, has been looking at this for a number of years. And anything that we can do, we think, to support on the supply side constraints, whether that's issuing the long-dated government bonds or corporate bonds to help providers of these products, or whether it's increasing demand by actually helping people understand income as opposed to account balances. So one of the questions we had on there didn't have quite the same level of support, is that super fund trustees be required to show projections on annual statements. So to give you the concept of, if my account balance is X, what's my retirement income? That's something that the superannuation projections and disclosure subcommittee of the super practice committee's been looking at for many, many years and has been surveying members on. So it is an area that I think the debate perhaps is compulsion as opposed to best practice, and maybe an alternative route for policy might be, we suggest that under the member outcomes framework, whether it's SPS 515 or SPG 516, we actually follow a route where you're encouraged to put them on member statements, but not required. There's so much legislation and regulation at present. I think there's, I think trustees are struggling on this. So I might just move in the interest of time to the one last point, the one that you raised, Naomi, about the home. How do you incorporate the home into retirement incomes? Our membership surveyed was a resounding yes. You actually need to have a role for housing equity to support retirement incomes. So the real question is how? Both the retirement income system and the way things are taxed encourage investment in the principal residence. But there aren't that many people who draw down on that equity in retirement unless it is actually downsizing their property. There are alternatives out there, where there's the government's pensions loan scheme, which is not taken up too much, but it's actually a good scheme to top up the age pension. We've got commercial reverse mortgages, home reversion schemes, but again, it's not in the mindset. It's not generally thought about, and hence the home often becomes part of the big bequest. So part of the issue thinking about there is, if there is a tax advantage in helping you save in the super as a whole, could you actually require some elements on home equity? Now, the Institute hasn't got a policy in this area, but we are running a session at the Actuaries Summit on this the end of next month. There's a paper being presented on this. And I think that would be really interesting and help us form a position of how you might do this, not if, because we're all saying yes, but actually how we make this happen. So Naomi, I might just pass back to you here in the interest of time.
Great, thank you, Tim. That's really interesting. We'll go back to some of the questions shortly, but before that, I'd like to introduce Anthony Asher to speak to the last two. It's interesting, neither of the last two questions on the survey, and maybe if we can get the survey back up, Zoe, neither of the last two questions had strong support from members. I was quite surprised, Anthony, about the second to last one, because I think effectively with the Institute's work on the intergenerational equity thing, that I would have expected very strong support for that second to last one. And with the final one, Anthony, this is very much your idea and initiative, and I thought it could be the way we worded it, or I think members would really welcome hearing you talk to that last one and what your thinking is there.
Thanks, Naomi. I'm going to try and share a few slides and see if that works. But yes, I think I was a little bit surprised at the lack of support for the second last question. But I think partly because there were in fact 3 questions in one and people couldn't support all 3. So this is what I want to talk about, which Naomi has just mentioned. The proposal to automate data is work that I've done with John DeRavan, and we've shared with the Retirement Incomes Working Group on advice, and I'll go spend some time talking about that, which is relatively new. But just first on the, if I can, yeah, there we go. The coverage, expanding the coverage. I think for those earning less than $450 a month who are currently excluded from the SG, this is unfair, and it's effectively relatively complicated. It would be much simpler to pay everyone regardless of how much they were earning. And it's unfair because you can be earning 440 and not get super, and then earn 460 and get 10% super, which is or 9.5% super, which is a nice deal. So, and I think there's discussion about people working less or being given fewer shifts so that they don't go over the 450. So that really, I think, I would be surprised if people are not in favor of that. Contractors, especially those in the gig economy, I think are more difficult. If it comes out of pay packets, which I think probably what will happen, one's left with 2 arguments. One is that they're effectively employees and should be treated as such, which is a political question and goes to leave and all sorts of other things, as well as super. The other argument is that we should actually be including all earners, including the self-employed, and it's difficult to include the self-employed, but quite easy to include contractors, so let's include the contractors. I'm not sure. I think the flexibility of being able to contract allows you to get that much more cash, and perhaps people are making that decision purposefully and intentionally. Maternity leave is similarly a little more difficult. In the long run, presumably the cost of maternity leave will stabilize, including super, so it will come out of entitlements. One's got to make the argument that family cash flows are already tight when children are young, and I've got to make that because I have 3 sons in that position and who would be furious if I didn't. They don't want to contribute extra to super. They want cash now. In fact, they don't want to contribute anything to super. And they've done the modeling, and I agree that they probably would be better off if they didn't have to. On the other hand, the argument is that all remuneration should include SG contributions, and it would be simpler in some respects. So one could make the argument that that those on maternity leave should get super contributions. And there's definitely a perception out there that women are discriminated against because they don't get the super on maternity leave, and whether their perception is right or not is in some respects perhaps not even material. It'd probably be easier to give SG on maternity leave. I do want to make the point that I've made at the end there. It's that I haven't made a strong argument either way, except for the 450, because I think it is unprofessional to make tendentious arguments to try and take a position that, for instance, that SG should be increased and cover more people that benefit the superannuation industry without considering, in fact, the impact on the recipients. So I think as an institute, we've got to be really careful about appearing to take a partisan position or a position that is actually speaks to for the super industry rather than for the members. Right, that's on that, which is, you've probably heard some of those arguments before. These you might not have heard because I hadn't heard them before I started working on them, well, some of them before I started working on it last year. So financial advice is complicated and is costly. There's no doubt about that. The industry blames the regulators. ASIC blames the industry. Conservative compliance teams that attempt to stop less qualified advisors, and I've given a link there. There's a link here if my slides can go up at some point. There are also significant conceptual problems with current practice in giving advice. Investment risk is often misunderstood as short-term rather than long-term volatility. Longevity risk is often understood and addressed by adding a few years to life expectancy, which is not adequate. The Institute made submissions on this score. People are often advised to take more risk if their projected income does not meet some arbitrary goal, and that's clearly a bad idea because the downside is going to cost you more than the potential upside. People are often wrongly assumed to have formulated personal financial goals when really they should want to maintain level normalized expenditure throughout life. Normalized to allow for the fact that the family, you have children coming and going, and you've got housing costs that are also not level. And I'm pretty sure that annuities are discouraged because there's no ongoing need for advice and trail fees, and the industry doesn't like annuities for that reason. I've made that argument a number of places, a couple in the link there. So even if you don't agree with all of that, ASIC and the industry all agree that the advice model is broken, it's too expensive. So how can we make it cheaper? So the idea is that, and I think, the point that Andrew made and that most of you, a majority of people say, is how do you determine the SG rate somewhere between 9.5 and 12 with advice? And of course, when you come to retirement, how do you determine how much you should put into an annuity, life annuity, without advice? So a vision for superannuation advice that all members are provided with meaningful personal advice on how much to save and spend throughout life at reasonable cost, at key points, starting out, having children, buying a home, when the children leave home, and when beginning to think about leaving the workforce, where you've got to make these decisions. And all right, then appropriate annuity type product types should be included in that advice. So the proposal that we've been developing over the last year is that the data required for this advice, which is expensive to collect and very difficult to actually make sure that the data that you've collected is accurate, I mean, do you know where we know a lot of people have missed out on their super and a lot of people can't tell you what they're spending, precisely what their assets are. The data for this could actually be collated automatically, saving costs and improving quality, and then provided to the to members in a automated fashion that prevents the errors that I mentioned in the previous slide. Now, the data are held already by various government agencies. Some of them are provided by financial institutions to the government agencies, some of them like Medicare don't. So the question is, could we collate it through MyGov or another agency, or should we be looking for private data aggregators like is happening effectively with the consumer data right? I don't know whether any of you have used it, but basically, we recently applied for a mortgage. All it was a click, and the mortgage broker was able to get all our bank details from every bank around based on that click. And that's something that has emerged from the European Union, now applies to banks, and will be applied to telecoms and power companies, I think, in the next few years. So the possibility of doing that, well, we know it can be done, and the privacy questions have been, and accuracy questions have been addressed, so it's possible. So what data are we looking at? Demographic, age, household composition, and health. That's available from Medicare. Historical income, so that you can project your future income, and work out, in fact, how much you've been saving. The taxable income is available from the ATO. The welfare benefits from Services Australia, that used to be called Centrelink. You want also the historical development of your assets, including superannuation, property, bank balances for projections, and to determine what risks type and saving patterns you've been doing. The ATO's got that, although it doesn't have full historical bank balances, although it's able to get it. And Services Australia has it if you've had any welfare benefits. And then the tax office has access to vehicles, boats, caravans, and farming equipment and materials, if you happen to have the latter, from the Personal Property Securities Register, which I hadn't heard of before, but that apparently exists. So from the ATO's website, amazing. They collect information. They say we collect information from your employers, your bank, your health insurance fund, the BAS statements, super accounts, and property information that your state may have. And then they make reference, I think, to the property thing I've just spoken of, Personal Property Securities Register. They know more about our finances than we do. So well, maybe you know more than you told the ATO, but they've got information that you don't know about. So part of the consumer data right and privacy principles are that you should have the right to get that, to know what other people have, to know the data that other people have on you. So there's a right to get that data. And in fact, if it can be used to automate and make advice easier, surely we should be encouraging it. Feasibility. There's some research recently that showed that it's possible to match the last 40 years of ATO data with Medicare, Social Security, and the ABS census in over 93% of the time of the occasion, or 93% of the time. So the data is not perfect, but pretty good. And of course, there's a lot of other initiatives through the Digital Transformation Agency and the Office of the National Data Commissioner. Government's doing a lot already, and they're very eager to do more in the digital space. That's why Jane Hume has been appointed as the first minister of the digital economy. And it's really quite good that she's in the, she's also Minister of Superannuation. We have spoken to her, and she's vaguely, without committing herself, she seemed quite enthusiastic. I'm not going to spend time on this, but basically you can work it out. If it costs $2 billion is spent on providing advice. Providing the information from the ATO just has to save 1% saving would save 20 million a year, and the costs are minute in comparison. An API project which is required is so that the interface, about £1 million a shot, $2 million, very, very cheap, relatively speaking. And as I say, with MyGov and the Banking Consumer Data Right, we've shown that it's possible. Other people, the Financial Planning Association, there's an administrator, the FinTech Australia, are keen. We've spoken to people at APRA, ASIC, the ATO Treasurer, and to the Minister. None of them, they're all open to the idea. No one was closed. So I think it's a fantastic idea that will really make a difference to a lot of people in providing inexpensive advice. So I've got an appendix in case you have questions, but back to you, Naomi.
Thank you so much, Anthony. And who says that actuaries don't have hairy, big, audacious ideas? And I think that we will all be interested at the end of this session as to whether the votes for that last information have increased or reduced, heavens above, as a result of your talk. So thanks very much, Anthony. I'd like to go to some of the questions now in the Q&A, and please do leave questions if you want. We've had a couple of good questions from David Rush, and one of the things he says is there is a theme here about the Institute not wanting very tax privileged superannuation to be left as bequests. So why doesn't the Institute have a public policy statement about that? And in particular, for example, you could have it that either you can't pass on tax privileged money as bequests, or that if it's left as a bequest, for example, that it would have a catch-up tax for the benefits that it's had. So it was much less attractive. It was much more attractive to actually spend the money in retirement than to pass it on as kids. And there's lots of, it sort of fits in well with the general themes as well in here about spending down the house and stuff. So I was interested, either Tim or Andrew, you know, as your views as chair of the SBC or chair of the Retirement Incomes Group, do you think the Institute would ever have the courage to advocate to Treasury or government a direct response, you know, to actually cutting off tax privileged super as a bequest at the point of somebody's passing away? Tim, I might start with you.
Okay, thanks, Naomi. It's a really interesting one, isn't it? I think it's a great suggestion. It would take courage, because I originally headed over from the UK all those years ago. And one of the things that struck me was we didn't have death duties when I came across, and I was used to that, and that changes behaviour. And in one sense, this is a form of that, albeit quite targeted to where there's been a tax privilege to get that through. So we need to be careful. It wouldn't be necessarily politically popular with the electorate, but it does solve the problem. If that's the problem in the Retirement Income Review report, it would be a disincentive to save, as it were. You would actually look to spend. So I think that is something we should look forward to. Andrew, can I pass to you?
Andrew, what are your thoughts on that?
Yeah, no, I think, well, a couple of things really. One is that in a way we sort of do already, and it's unfair to some extent, because if you, when you die now and your benefit is not paid to a dependent, then it is taxed at 15%. So not many 80-year-olds will have dependents from that. Oh, sorry, they'll have a spouse, and the spouse, when that person dies, will then not have any dependents, and so then the residual assets then are taxed at 15%. And in that situation, if you know you're going to die, you simply take all your money out and it's tax-free. If you die unexpectedly, you pay 15% tax. So that anomaly is really weird and should be addressed. But anyway, that's one side of it. The second part is politically an easier thing to do, and we used to have this, you know, we have a minimum drawdown from a pension, which I think should be higher. And we should also have a maximum drawdown, so you can't take out a lump sum. So that if you know, to avoid that 15% tax, you can take all your money out. Well, let's just So you need to be withdrawing 5 or 6% of your assets as a minimum each year, not 4%. And maybe that's a maximum as well, so that you can't take it out too quickly. So it's between 6 and 8%. Some people might say, well, hang on, I don't want to spend 6% of my money in my first year of retirement. I'm not saying you have to spend it. I'm just saying you have to take it out of a tax concessioned environment and put it in your bank account and pay tax on it. That's fine. But tax concessions, if we're going to provide them, should only be provided for income in retirement, and we should be forcing people to gradually take money out of a tax concessioned environment. Of course, for people with low balances, they'll take it out of superannuation in the normal tax environment. It's only once you get above a threshold that you start paying tax on it anyway. So it'll be tax-free outside of super for most people with low balances anyway. So there's really no difference, but we shouldn't be allowing people to leave money in super forever.
So if I could just add to that, Naomi, sorry, just to come in over Andrew, extra point there, that if you have a maximum amount that you can take out, so that's there, maybe you actually say you can take out more, but you've got to pay extra tax on that component. And it would probably fit to Andrew's point.
Absolutely. So anything above 8%, you can take it out, but pay 15% tax on it. Pay back the concessions that you've been given previously.
Thanks, Andrew. And it sounds like we would have a lot more political acceptability if we actually talked about those earlier ideas around limiting the absolute amount that can sit inside the superannuation system post-retirement, or introducing a further tax on those retirement income investment. Do you have a preference, Tim or Andrew, for either of those approaches, limiting the total amount or possibly even introducing a marginal tax onto earnings in retirement?
The marginal tax rate is conceptually appealing. I'm not sure how easy it is to administer in a large APRA-regulated fund, but that's a separate issue. But if it could be administered simply, then that would be quite appealing. But at the same time, I'm not really sure why we wouldn't have some sort of limit. One has been banned around publicly recently for a number of reasons of $5 million. So the limit can be changed by politicians. But if you had a limit of $5 million, if you go above that limit and it stays above it for a minimum of 12 months or something, you have to take out the excess above the limit and pay 15% tax on it. If investment markets then fall, I think that limit is reasonably, so high enough that if it falls and you lose 10 or 15% of the assets temporarily because of a crash, you're still doing fine.
And Anthony, you've said earlier, and I agree, that it's incredibly important that the Institute with its public policy positions is not seen to be trying to line the pockets of the superannuation industry. Presumably, if we had a public policy position that there be an absolute cap, of $5 million, and you had to basically get it out within 12 months, you'd pay 50% tax, and after that, you have to manage it yourself at your marginal tax rate. Presumably that very clearly is not in the interests of the super industry and would be seen as sound public policy.
I think so. And in fact, I think Deborah Wilson's made the point a couple of times that actually the whole super industry is brought into disrepute when people have got $100 million in super not paying tax. Actually, it is in the interest of the industry even to stop what appear to be, may not be important in the national accounts, but really do appear to be egregious benefits to a very few people.
That's right. Thank you.
Can I just add on that? I think it's an important point, because I think it's, we've got various principles that make the system sound. Like one of them is sustainability over time, another is equity, and equity is about perception. And if the perception is that it's not equitable, then the community loses faith in the whole system. So we need it to demonstrate that it is, as far as we can make it, equitable.
That's a good point, Andrew. We had a comment there from Janice, just I think really arguing that all remuneration should include SGC contributions. And Anthony, coming to your comments about that, I think that you were broadly supporting that concept, that if it was actually remuneration from an employer, that it should be, it should attract SGC, whether it was under 450 or paternity leave or parental leave.
Yes, I think I'm probably on that, in that area. I think the point that Janice makes about super on divorce, I think is another issue, and really important that family law divides the super appropriately. I think that's some of the most useful thing I've done is help some of our friends that have got divorced and get them to argue that they should have not just top up to equalize, but actually recognition in future earnings of the suffering, the cost of taking parental leave has an impact. I mean, the statistics would vary, but I've seen numbers that show that you decide to have a child, and if the mother takes maternity leave, her future income is halved. And I don't see why the fathers shouldn't be responsible for compensating for that.
Thanks, Anthony. Anthony, there's a question here from Janice Jones where she's asked whether this affordable advice model that you're talking about should be charged back to the superannuation fund. Who do you see as financing this model?
I do see the super fund. Obviously, someone's got to pay. I think the ATO could actually provide the data pretty much free as part of their. It really is. It's so trivial. It's not worth them charging. I'm not sure. I think super funds could pay. Advisors could pay. But my view is that what I have in mind is a situation where all the data is put together, the calculations are done, and you sit with a financial advisor for an hour, 5 times in your life, and you pay them $300 to interpret what's there. It's not a lot of money. And if the super fund can manage to load that into their fees, well, all well and good. But I think most people pay their $300 to their tax advisors so they don't have to fill out their tax forms every year. I think $300 is quite a manageable charge.
Thanks, Anthony.
Wondering if I could add to some of those, Naomi. I think the whole advice situation we have heard is very complex. The fact we've got the age pension that's means tested on top of superannuation means it's really, really hard for a super fund to actually understand where things are. Even with the information from ATO, things change. Your situation today might not be your situation in 2 years' time. That's perhaps why some people have advocated a universal age pension, just to make it a bit easier on some of these things. Not saying it conforms to community expectations of equity, depends how you look at that. But there are things that can be done, yet the retirement income report ruled some of these out without further debate. So I think it is interesting, and to this whole point about advice and super is something which needs to unravel. Perhaps we need to separate it from some of the arguments on retirement income policy, because it's such a big nut already. Maybe we need to take it to the side, but I think it is an area where actuaries have a role to play.
Thanks so much, Tim. We've got a question from Estelle Yu, and she was basically saying, given the retirement income review found that members are not drawing down enough, shouldn't we as the Institute provide guidance on what would be an appropriate drawdown? Andrew, I think you kind of alluded to that when you said that we should actually recommend an increase in the minimum drawdown, but also a maximum drawdown. So it sounds like you would probably support the Institute giving some more guidance, possibly around a change in those mandatory drawdown rates.
Yes, I would be supportive of that. I mean, I think tax concessions are provided for providing income in retirement. I think that goes to one of the other questions that was asked earlier as well about bequests. That the tax concessions aren't provided for bequests. We should be encouraging people to draw down their savings, their superannuation savings in particular, progressively throughout retirement, and give better guidance on what that is. And I think to some extent, some members might use the current drawdown rates as guidance. So maybe the guidance needs to be better.
That's right. That's exactly right. So we're up to 1:30 now. We've got a few more questions coming in. One of the things that Boal has asked is, given that we need to focus as an institute on some key areas, we're going to have to limit the issues that we actually focus on. And where can we get the biggest bang for our buck? You know, is it this area around equity in terms of overall there being too much in the systems, say for the high balances? Is it the area of giving advice around drawdowns post-retirement? Is it the area of developing more products? I'd be interested in all of the participants' thoughts on where can we actually achieve the most change. Maybe start with you, Tim, then start with you, Anthony, then we'll go to Tim and then Andrew.
Thanks, Naomi. I mean, I think the question asked earlier, I think it was anonymously, about where the factories can make more, where most jobs can be produced, actually is perhaps not the right reason to go for those two items, which I think are life annuities, requiring trustees to do to provide some sort of lifetime income, and the advice issue. But they do show where we have particular expertise. So the equity questions and the political questions are so fraught that I don't think that our technical skills make much difference. But in questions of developing lifetime incomes, where they are needed to protect those who are going to live beyond their life expectancies, and the nitty-gritty of making projections and doing advice, I think we have an understanding of that which actually no one else really understands. I mean, sorry, that maybe that's arrogant, we've got to be really careful about. But there are major issues that are not properly understood, even by actuaries. I mean, you get actuaries that will recommend, because their utility functions say that you should take higher risk in order to meet your target. Now, that's just wrong. You know, it may be the right, it might be the right answer, but it's the wrong reasoning. You've got to take into account the loss of utility from having a bigger loss. Otherwise, you're recommending people gamble. So I do think those are the two areas where we should most focus. And certainly in the Retirement Incomes Working Group, that's where I focus my time. And I don't think that one of the reasons why we set up different groups is that we can do the work we've not. There are 20 of us, perhaps. There are another 4,980 actuaries that can do other things. So I'm not really saying that other people shouldn't do other things, but that's where we're going to focus. That's where we are focused.
Thanks, Anthony. Tim, what are your thoughts on where we should prioritise our focus?
Yeah, I'm with Anthony. I think the focus, I mean, there are so many different areas, but I would focus on retirement income. It's actually to get people to focus on income, not account balance, all the different steps, not necessarily retirement income product, although that is one of the elements. So I think the first area is to encourage the government to implement the retirement income covenant ASAP as the foundational step. And then from that, use that as the springboard for retirement income product, for actually expressing things in terms of income and having people think that way in a holistic fashion.
Great. Thanks, Tim. And Andrew, are you thinking the same?
Yeah, boring. Absolutely the same. But I think, and I wrote this in my dialogue last year, that we do need a focus on longevity protection and products that support that. But we also need to have better access to affordable advice, and to Anthony's earlier points, so that people understand how and when to use them as well. So there's no point having a great retirement income product if advisors and consumers don't know how to use them. So, and technology is a huge part of that. And so we're fortunate, I think, that the Minister for Superannuation is also the Minister for Technology. And getting the triangle working together about product and advice and understanding, helping consumers to actually see how it all fits together, I think is essential. And there's no point, and also getting the regulation settings right. So the taper rate was one that I was quite well, critical to one extent of in my paper, but I think there's no point fixing up one part of it all. You need to get the regulations right, you need to get the products right, and you need to get the advice right. And if you don't get all three right, then it's useless doing the other two on their own.
Great, thanks, Andrew. There's one question here from Anonymous, and it's an interesting question. It says, can expanding the scope of what fund advice solve the advice affordability issue? And noting that most super funds do offer intra-fund advice and that most members don't actually use it. Tim, I'd be interested in your thoughts on intra-fund advice and why it's not used, and whether if it was expanded and what could be defined, then that would go quite a long way to solving the advice issue.
Just to really intra-fund advice basically means everyone in the fund pays for it rather than you, often. So think about what are you allowed to do in that context. Yeah, there is a lot to be said for adding a few things you can do to the list. I mean, one of the things we hear all the time is that intra-fund advice is limited to you being a member of that fund, and your partner often isn't a member of your fund. So how can you actually holistically provide a solution in that situation? I could go on further, but I know Andrew's actually done some work in this area, so I might actually pass to Andrew. He's done some research and probably the better voice on this.
Yeah, no, thanks, Tim. I think what you said is right, that allowing people to get advice about their partner and a whole lot of other things can be just as important as just their own. In fact, if providing advice about one person's account when they've got a spouse with a superannuation is close to useless as well anyway. I think a key part of advice is around strategy. And in a formal life, years ago, I wrote a paper for the Financial System Inquiry and about advice, and drew upon some work done in the UK on advice over there. And I strongly believe that 80% plus of the value of advice is around the strategy that people take. So how much do I need to save? How do I invest it? How much in growth assets? What products do I need to draw down on in retirement? A little bit of value is added at the end about which product. Is it the Commonwealth Banks, or is it Aware Supers, or is it somebody else's? The product piece adds little value in comparison to the strategy value. And so when you start thinking about it that way, how do we get more effective strategic advice into the hands of the consumer and the member? And to Anthony's earlier points, it's event-based. So I don't want to be talking as a 24-year-old about retirement. I want to talk about saving for a house. I want to talk about other life events that I'm about to go through. Help me with those. And in fact, in some of the work we've been doing lately, it's the number one thing you start thinking about for retirees is how much do you need to spend in retirement? They go, I don't know. How much do you spend now? I don't know. No one, how many people do a budget properly for themselves? So helping people do a budget for retirement. And of course, when you go back at the start, that's the number one thing that 24-year-olds need, is help with budgeting. And once again, to Anthony's point, getting data straight through from the banking system and other systems to say, actually, we've got this algorithm which can break down your credit card and banking account details, and we can give you a snapshot of how you spend your money now. What a great start. And then beyond that, I think advice should then, we did a paper on this at Rice Warner recently, it should be risk-based, that if somebody has the potential to, with advice, be put into a product that is huge risk and could bankrupt them, then they need advice, and it needs to be done under an SOA. But if it's a matter of choosing between Bank A and Bank B's product and the difference is marginal at best, then why are we paying $2,000 for an SOA for marginal advice? So the whole system needs an overhaul of how we think about advice and how you pay for it.
Thanks, Andrew.
Can I come in there?
Yeah.
Sorry,
sure.
Amy. I agree with Andrew almost with every point he made. But when we've actually spoken to advisors, one of the surprising things that I found is that they spend a lot of time actually advising people on spending. So they need the data, as Andrew said, but it's actually a coaching role So part of the story is actually, we do need to focus on that, just that. And one of the things is to say, well, actually, this is how much you've been spending, and this is how much you've saved over the last little while. You've actually got to do better, or in fact, you're being ridiculously prudent. Go out and have a holiday, or otherwise you'll be retiring at 50. But whatever.
But it's a great point though, because when you look at how much you are spending and this is how much your retirement savings will allow you to spend, you can start going, so which are the things where they're going to cross off your list that you're not going to do in retirement?
No.
I just want to go to a question here from Diane Somerville, and it's back on the question of whether all remuneration should include SG. And Diane makes the point that I think came out of the Institute's, intergenerational report, that is, with the prevalence of more people working flexibly, there's going to be more and more people outside of the compulsory super system in the future. And that maybe rather than super funds having a role in it, that the ATO is actually in the strongest position to, require and collect superannuation contributions for gig employees. I was interested if any of the panelists had any thoughts about that.
I like the idea.
Tim?
I'll just add that when you look at the comparison of the Australian retirement system to overseas, this is one of the areas where Australia ranks more poorly, in that the coverage we have for super isn't as universal, say, as in Scandinavia on there, or the Netherlands, where there are ways to incorporate more people in the net. Now, as we've talked about before, there are issues with that. There's a plus and a minus. But I think that anything like this with technology and data being so much better than it was 30 years ago when SG was put in place, I think actually it's beholden to think of these sorts of things and actually say, is this the right way forward? Actually have that debate. It's a good idea, I think, from Dan.
Yeah, I agree. It's a good idea too. And I think as long as we can get it done, I think from a policy position, I think it's also fair to say that we shouldn't have a system which encourages bad behaviour and is inequitable. And so I think if you look at the $450 threshold as one example, and it extends then to the others, but I know of employers, because you can see it happen with your own children, that having children working for supermarkets or other places end up earning $440 in a month and don't get any more shifts until the next month. So why do some employers get a 9.5% cheaper workforce than others simply by manipulating the system? So from an equity point of view, all employers should be on the same footing to make the market competitive. And so everybody should be having the same expenses added to their bottom line so that it's a fair system. And that would go to employers of gig workers and everybody else. And self-employed, why should their costs be 9.5% lower than a competitor because they happen to have a different structure?
Thanks, Andrew. And I get the feeling just from some of the comments coming up here that there'd be quite strong support for the Institute to go out and talk about that. It's nearly 1:45, so we just maybe got room for one more question. And I do apologise, there are so many questions flooding in. And because of my computer problems, I had to switch to my iPad, and it's very hard to see all of the questions, and we haven't had time to answer them. But just maybe one final quick thing. We did put in the questions some comments about whether the age pension should not be means tested and whether it should just automatically be given. And Richard Codron has asked a few questions about, Andrew, your comment that that would be very expensive to get rid of all of the rules and regulations about the age pension. But he's making the point that if we did that in conjunction with having a cap on the total amount in the system and having a 15% tax on pension income, that's actually going to be quite cost neutral and enormously simplify the whole system. I wonder what your thoughts were on that, Andrew.
Almost did the unthinkable and speak on mute. Look, I think there's merit in those points, Richard. I agree. So I think the 15% tax on in pension earnings will help fund some of the costs of the universal pension. I think right now, the cost of the age pension is about $50 billion, 2.4% of GDP, and the contribution of tax concessions is another 21 billion, and investment tax concessions is another 18 billion. At the moment, about 45% of pensioners get the full rate. And so if all of a sudden you had 100% of pensioners get the full rate, and also, yeah, that would be sort of almost doubling the cost of the age pension, and which could be funded by getting rid of some of those other concessions. But over time, I do suspect that our costs won't stay at the same percentage of GDP, that they will, because of the aging of the population, those costs will blow out in terms of a percentage of GDP. So at the moment, they're going to stay under 5% in total, but I suspect that a universal age pension would start, because in 2060, it's projected under the current cost that 40% of pensioners won't be receiving an age pension, and only 20% will be at the full rate. And so going to a universal age pension will be much more expensive in 40 years' time than it is now. So we just need to keep some of those things in mind as well. I haven't done the numbers, Richard. David Knox probably has, but he might send it through on the Q&A, his answer. But something we should certainly look at is getting the maths right and all of those things and examining it. But I do think the means tests do help control some of those costs. One of the things I should mention, though, I think it was in the Q&A, it was brought up by somebody, and it's also, I think might be something done somewhere overseas, is that there is a universal age pension and a means tested age pension. So you have two. So everybody gets something, and if you want more, the second part is means tested. And so that's an in-between answer that might cover off some of what we're thinking about.
Thanks, Andrew. It probably ducks a little bit because it's all of the complexity, but some of the cost of the universal thing. So it's very interesting. I'd just like to comment for those of you who can see the Q&A that we've had some strongly voiced opinions that the Institute should be doing more public policy around these areas and much broader, and some really great ideas there about, pushing for better financial education in schools and literacy. And then we've had other people commenting that really, what do actuaries know apart from the technical stuff around longevity and stuff? So we should really stick to our knitting around. So you can see even the question of whether we should have public policies is contentious with a group of actuaries, let alone agreeing what they should be. So thank you very much, everyone who's typed questions, and our apologies that we haven't had time to get to all of them, because we did want to ask you to resurvey those questions and see whether people have actually changed their views a little bit. So what we're now going to do is get everybody to vote. So hopefully on your screens, you will see that we're resurveying poll question 1. And you'll recall that the highest support was for the SG rate being somewhere between 9.5 and 12. We weren't expecting that this would change drastically as a result of this conversation, but we're interested if everyone can re-pick on their screens which of those they now think we should go with. I think at the moment, as a result of this meeting and the survey, we will probably continue with our current policy, which is 9.5 and 12, unless, of course, the survey now shows a drastically different result. So we've got the results up now, and basically we've had an increase in the interest in keeping it where it is. So that's quite a strong vote of support from that. I'm sure, Anthony, that the ethicists among us would say that there was a lot of priming bias in the way that question has now been asked. But it's interesting, and thank you for that. And then secondly, if you could now answer those 10 questions. So basically, if you could go through and vote on all of those questions. And thanks everyone. The questions to those are coming in. You'll see that unfortunately on Zoom, we could only have 10 questions being asked. So we've had to drop a couple of the questions off. But hopefully everyone can quickly go through and think about whether they've changed their mind. And I guess I was interested with the SG contributions on earnings less than $450 a week. Whether people had changed their minds a bit on that once we discussed it a bit, and also the last one about the advice system, whether views had changed. So again, it's interesting as a result of the discussion, the areas where we had some support have actually increased their support. Very strong support there, you'll see for the first one about addressing the equity issues due to those high super balances. So I think, Andrew, in terms of the numbers that you were kicking around, you know, about the 5 million and so on, that's a very strong show of support for that option. We've also got very strong support for part of the value of the home being included in the age pension means test, so that's 73%. Also for this issue around retirement incomes being spent in retirement, not passed on to others as a bequest. And then I'm pretty pleased to see that the support for the SG contributions has gone up. And I think that's just reflecting the discussion we had about applying it to all earnings. And then, Anthony, you've increased the vote for the last one.
But not enough, not enough, Naomi, but maybe people didn't get to the last question.
Maybe it was. So looking at that, Tim, you're currently the chair of the Superannuation Practice Committee. What do you think of that first? I mean, that first one absolutely has the strongest support, you know, from our members on this call. Do you think that's something where the committee working with the retirement incomes group could actually go away and develop, you know, a considered public policy position that we could give to Treasury?
Absolutely, Naomi. Just to help membership, there was an Institute Retirement Income Policy back from 2014. With the retirement income review, that was withdrawn whilst we considered these issues. But looking at that position from 2014, this would fit in with that actually. And as we develop the thoughts from here, we actually have quite a good framework, I think, which we can add to from what we've heard from the discussion today. Yeah, an SPC will work on that and then put that through the Institute's a retirement strategy group, public policy committee, and again, keep feeding in response from members on this. It's important, I think, we have a policy, that we have a voice. We are respected, back to the point we raised in the first place, and it's beholden on us, I think, to actually be bold, but be bold in a considered fashion. That's not an oxymoron.
Thanks, Tim. And I noticed that the second most popular item there is actually that part of the value of the home above a threshold should be included in the means test. Andrew, presumably this is something that's very hard for political parties to ever advocate, but can you see that the Institute could advocate this position? We've obviously talked about, you know, intergenerational equity issues a lot, and I think in some ways this this feeds into that discussion that we talk about.
Yeah, certainly the Institute can advocate for that. And in fact, I think from memory, we already have on a number of occasions made that suggestion. It might have been a suggestion rather than a recommendation, but certainly when I was chair of the SPC, we did make a number of submissions to Treasury over the last period of time that consideration should be given to including, to exactly what it says there, including something above a threshold in there for equity purposes. So I think we should continue to do that, and possibly even stronger. And I think the Institute is possibly even getting a working group together around, we've had the green paper on housing wealth, but I think we should also be continuing to do more on this topic. Thanks,
Andrew. I'm very interested in the next two answers, because we've actually had an increase following this discussion on trying to reduce the amount that's passed on as bequests and getting people to spend it down. But we've had a reduction in the focus on super funds, you know, being made to offer retirement income products for their members. And I wonder if that is actually showing that the people on this call at least are more interested in us giving advice, you know, around those, increasing those minimum drawdowns, as opposed to putting the focus on, you know, super funds developing or being forced to offer more products.
And Naomi, I'll just come in quickly. We might have got a different answer if we had not said be obliged, as in you must. If you actually said you have flexibility, so you're encouraged as opposed to must, I think you get a different answer.
I think that's right. I think there's general feeling within the profession, and is reflected in both that answer and the answer to the last question, that we don't want government to be requiring people to do things. I think that my own view, that's probably a bit too ideological and needs to be examined a little more carefully, because government does do lots of things, and we don't want, they can very often do quite useful institutional structures, but I do think I hear what people are thinking, I think.
I think, can I just add to that, because we're conscious of time as well, but I think there's certainly, we've got the DDO obligations coming in soon, where funds have to have a target market for their products that they're offering. I think what this is saying as well, which we want to make sure the nuance is correctly understood, is that they should be made to offer appropriate retirement products for their members. Doesn't say what that product is, and doesn't say that the members have to take it up, but they should have appropriate, I think funds should have appropriate retirement products for their members, and they should be made to offer them. If they have inappropriate products and don't offer them to members, what's the point? What those products are is up for debate, and I think the products will be different for different cohorts of members. So, for example, a person with $100,000 retirement saving in their superannuation probably doesn't need an annuity or longevity protection because the age pension is enough. For them, an appropriate retirement product just might be being able to access the money as and when they need it. That would fit that description, I think, in my mind.
Thanks, Andrew. And that's probably a good point at which we'll finish the discussion. Hopefully everybody on the call has enjoyed it and has got an inkling as to why it's complex for the Institute to develop a formal public policy position in this area. And part of it is not only that we have so many experts on super within the Institute and the membership, but also just that we are all affected by super. You know, we all have super. We understand it, and we're all very passionate about the issue. I think for those of us on the Public Policy Committee, it's been very gratifying to have this discussion and your contributions as to where you think we could set public policy. And I'm sure that all of us will go away now to work out how we can actually develop some formal public policy positions, which obviously you won't all agree with, because we've seen that nothing had 100%, but hopefully will be good for society and good for the Institute and positioning our positions and leading to a better super system in Australia. So thank you so much, everybody, for participating and for your questions. Sorry again, we couldn't cover all of them. Many thanks to Zoe and the Institute team for hosting the webinar today and looking after us. Nathan, thank you for stepping in when my system died. And thanks everyone for participating, and we look forward to seeing you all at the next Insight. And special thanks to our contributors today. So many thanks, you know, Tim, Jenkins, Andrew, Boal, and Anthony Asher. We really appreciate your time. So thanks everyone, and we'll see you at the next Insight session.
Thank you, Naomi.